There is a number you have not seen on any news channel, not CNN, not Bloomberg, not Fox. $230 a barrel. That is what jet fuel costs right now in Singapore. $230 a barrel. 10 days ago, it was 96. Before the bombs dropped on February 28th, it was 94. 140% in 11 days. And nobody on mainstream television is talking about it. They are talking about crude oil. They are talking about 110 Brent, $115 Brent. Will it hit $120? And yes, crude oil matters. But crude oil is a raw material. Jet fuel is what actually goes in the plane. It is the processed, refined, finished product that airlines must buy right now to fly routes tomorrow. And the market analyst at KPILA, one of the top commodity data firms in the world, ran the math this week and said something extraordinary. He said, if crude oil had moved proportionally to what jet fuel just did, Brent would be trading at $175 a barrel right now. Let that land. $175 crude. We are not there yet. But jet fuel, the thing that determines what your next plane ticket costs, what it costs to ship a package, what it costs to move perishable food across continents, jet fuel is already priced in that world. The crack spread, the premium of jet fuel over crude, is up more than 350% versus a year ago. In Europe, jet fuel is trading at an $88 per barrel premium over crude. These are not rounding errors. These are historic dislocations. And here is why this number is the most important signal in the entire Iran war right now. Jet fuel is not a speculative futures contract. Airlines have to buy it. They cannot wait. They cannot hedge forever. Within weeks, every major carrier on Earth is going to have to make a decision, absorb these costs and destroy their balance sheets, or pass them on to passengers in the form of ticket prices that will shock people into cancelling travel. Airline stocks are already getting hammered. Delta, United, Lufthansa, Singapore Airlines, all down double digits this week. The war in Iran is not just a Middle East story. The $230 jet fuel number tells you it is already a global economic event, and it is 11 days old. I'm May. This is what changes. Today, we are going to go where the mainstream media isn't, into the commodity data, into Iran's actual strategy, into what China is quietly doing while everyone watches the bombs, and into exactly what this means for your money. Most wars in history have disrupted trade. Very few have had the ability to hold a physical choke point hostage in a way that could starve the global economy of energy within weeks. The Strait of Hormuz is that choke point, and right now, Iran controls it. Here is what most people don't understand about how the shutdown actually works. It is not just Iranian missiles. Iran does not even need to fire a single additional shot to keep ships out. The insurance companies have already done the job for them. Protection and indemnity insurance, the coverage that ships need to sail, was pulled for the region on March 5th. Without P&I insurance, no responsible shipping company sends crew into the strait. It is too expensive, too dangerous, and the crews themselves have the legal right to refuse. This is a war zone. Over 150 tankers are sitting anchored outside the strait right now, waiting. They can't move forward. They can't easily reroute around southern Africa without adding 15 to 20 days of transit time each way. Storage facilities in the Gulf are filling up. Saudi Arabia, Kuwait, Qatar, the UAE. They are producing oil and gas with nowhere to put it. They have already begun cutting production. Qatar declared force majeure on its LNG contracts. Qatar's energy minister warned, and I want you to hear this clearly, that if this war continues, other Gulf producers may be forced to do the same. He said, and I am paraphrasing, that this will bring down the economies of the world. The IEA is calling emergency meetings. Japan has asked to release strategic reserves because 95% of its crude oil comes from the Gulf. Europe is watching its natural gas prices explode, 39% in a single day on March 3rd. European TTF natural gas surged 27% the day after that. This is not a blip. This is a structural shock to the global energy system. Now let's talk about something the mainstream media is not explaining properly. Iran is not trying to win a conventional military war against the most powerful military force in human history. It knows it cannot win that fight. What Iran is trying to do is something far more strategic. Iran is playing a war of attrition, and it has more leverage in that strategy than most people realize. Think about it from Iran's perspective. The United States is projecting enormous military power into the Middle East: carrier strike groups, B-2 bombers, Tomahawk missiles, Patriot interceptor batteries. Incredible capability. But here is the dirty secret. Those Patriot interceptor missiles cost between $3 and $6 million each. Are the Iranian drones and older ballistic missiles they are intercepting a fraction of that cost, tens of thousands of dollars in some cases? Every time a Patriot battery fires, Iran wins an economic exchange, and those Patriot inventories cannot be replenished overnight. The supply chains are long and complicated. Are the rare earth materials needed to build replacements? China controls them, and China, at this very moment, has halted exports of refined petroleum products, diesel, jet fuel, gasoline, to keep them domestically. Iran is not trying to defeat America's military. It is trying to exhaust it, to drain its expensive missiles, to bleed its logistics, to force a political resolution before the United States can force a military one. And this week, Defense Secretary Hegseth announced that today would be the most intense day of US strikes yet. Trump says the war will end very soon, but Iran's new supreme leader has said nothing that suggests they are close to capitulating. Iran's IRGC said it is prepared and equipped to continue an intense war. Iranian officials vowed that not 1 liter of oil will leave the Middle East until the strikes stop. Trump's position is that the only acceptable outcome is, essentially, regime change and denuclearization. Iran's position is that it will block the strait until the bombing stops. These two positions are not close. They are nowhere near each other. One side says, "Stop bombing us," and we open the strait. The other side says, "Surrender completely and we stop bombing." Somebody is going to blink, or something is going to break. Now, I want to talk about something that is flying almost completely under the radar in Western financial media, because when you zoom out on this conflict, the real winners so far are not America. They are not Israel. They are Beijing and Moscow. China has reportedly allowed only Chinese-flagged vessels to pass through the Strait of Hormuz. Every other tanker sits anchored. China keeps moving. China keeps receiving oil. While the rest of the world's energy supply is being strangled, China's is being quietly maintained. But it goes further. China controls the rare earth materials needed to build the precision-guided munitions, the interceptor missiles, the semiconductor components that power American military systems. You cannot replace a Patriot battery without Chinese rare earths. Right now, China is the indispensable supplier of the very materials needed to fight this war, and China is not friendly to this operation. Meanwhile, Russia has been public about supporting Iran. Russian officials have stated they will do everything to ensure Iran is not defeated. China is reportedly providing satellite targeting intelligence to Iranian forces. This war is not just the US and Israel versus Iran. The geopolitical architecture behind it is far more complicated than that. For precious metals investors, understand what this means. De-dollarization just got rocket fuel. The entire argument for gold, that the US dollar's role as the global reserve currency is being actively undermined by a coalition of powers building alternatives, is playing out live on your television screen. Gold has been above $5,100 since before this war started. It hit $5,400 the day the bombs dropped. Analysts at JP Morgan have targets above $6,300. When the world's most powerful nations are openly fighting over energy choke points and supply chains, gold is not speculative, it is insurance. Silver moved with gold initially, spiking to $96 in the early sessions. But silver is a hybrid animal, half safe haven, half industrial metal. If this war triggers the recession fears that are now starting to circulate, silver will have more volatility than gold. But the structural story for silver, the supply deficits, the solar demand, the industrial shortfalls, that does not change because of this war. If anything, supply chains just got more complicated. I want to pause on something that happened this week that tells you everything about how the US administration is handling this. On Monday, US Energy Secretary Chris Wright posted on social media that the US Navy had successfully escorted a tanker through the Strait of Hormuz. Markets moved on that post. Oil fell. There was relief. Then the White House press secretary had to come out and say, the US Navy has not escorted a tanker. No vessel has been escorted. The post was wrong. Wright deleted the post. Oil recovered. The moment passed. But think about what just happened. The Secretary of Energy of the United States posted false information about one of the most consequential choke points in global trade, and markets moved. The administration is operating under enormous pressure to project confidence and control a situation that, right now, it does not fully control. Trump has called the war very complete, pretty much. He has said it will end very soon. He has also said Iran will be hit 20 times harder if they block oil flows. He has threatened death, fire, and fury. He said he is considering taking over the Strait of Hormuz, all in the same week. These are not the communications of a side that has a clear and settled plan. Iran, on the other hand, has been consistent. The strait stays closed until the bombing stops. That is a simple, clear, executable position, and every day it holds, the economic pressure on the global system compounds. The IEA is meeting. Strategic reserves are being discussed. Japan is already tapping stockpiles. Europe is scrambling. The question is not whether this causes economic damage. The question is, for how long? Let me be direct with you about what the data says and what the implications are. Oil above $100 a barrel for any sustained period is a tax on every economy on Earth. It raises transportation costs. It raises manufacturing costs. It raises food prices. It feeds inflation. And it does exactly what the Fed does not want right now. It makes the decision to cut interest rates harder and more politically complicated. The Fed was already paralyzed before this war. Now it has an inflation risk imported directly from the Middle East. Higher oil means higher inflation expectations. Higher inflation expectations mean the Fed stays higher for longer. That is bad for most financial assets. It is good for hard assets. Gold is already showing you what smart money thinks. $5,200 an ounce is not a bubble. It is a price signal. It is the market telling you that the geopolitical risk premium is real. It is structural, and it is not going away. Silver is more volatile and therefore more complex. But understand the underlying thesis. 5 consecutive years of supply deficits. Industrial demand from solar, EVs, and AI infrastructure is structurally growing. A gold-silver ratio that has historically compressed during precious metals bull markets. When the ratio compressed toward 57 in early March, that was silver screaming that it wanted to run. The chaos since has created volatility, not the destruction of the thesis. For anyone watching this who has been sitting on the sidelines on precious metals, waiting for the perfect entry, understand something. Wars do not create clean entry points. They create chaos. The people who benefited from gold's move from $5,100 to $5,400 already held it. You do not wait for the news to be good before you buy insurance. You buy it before you need it. Keep cash available. Keep essentials stocked. Watch the Hormuz situation every single day. If that strait reopens and oil flows normalize, there will be a sharp pullback in some of these prices. If it does not reopen, what you are looking at today will look cheap in 3 months. The regime in Iran has a new supreme leader. He has an incentive to show strength. The US administration has an incentive to show results. Neither side has announced anything close to a ceasefire. This war is on day 11, and the economic shockwave from day 1 is still working its way through the global system. I want to leave you with one number, 21 miles. That is the width of the bottleneck that 20% of the world's oil passes through every day. For decades, every analyst, every strategist, every risk model assumed no nation would be allowed to close it. We assumed the consequences were too catastrophic for any rational actor to attempt. We were wrong about that assumption, not because Iran is irrational, but because Iran calculated, correctly so far, that the costs to the rest of the world of the strait being closed are more painful than the costs to Iran of continuing to fight. That is a strategic insight, and it means this crisis will not be resolved by Trump's tweets. It will be resolved when one side's pain exceeds their political will to continue. We do not know when that is, We do not know which side hits that threshold first. What we do know is that the 21-mile gap is still closed, the tankers are still anchored, the gas prices are still rising, and the global economy is now in uncharted water. Watch the Strait, watch silver, watch what China does next. Those are your 3 leading indicators right now. I'm May. This is what changes. If you are not already subscribed, now is the time, because this story is just getting started.